France has just suffered a significant setback to its financial standing. On September 12, 2025, Fitch Ratings downgraded the country's sovereign issue rating from A plus to A plus, from AA minus to A plus, the weakest rating currently held by a major European economy among the big three agencies. This decision reflects a combination of persistent fiscal deficits, political instability, and mounting doubts about whether the French state has the capacity of or will to put its finances on a sustainable path. While the downgrade itself might not be immediately push France into crisis, it carries weighty implications for borrowing costs, investor sentiment, and the wider Eurozone outlook. For years, France has been grappling with rising public debt, driven by pandemic-era spending, expensive energy subsidies during the recent crisis, and a social welfare system that is politically difficult to reform. But what seems to have tipped Fitch into action is not just the numbers, but the political turbulence surrounding efforts to address them. Earlier this summer, the Prime Minister Francois Bayrou put forward a $44 billion austerity plan designed to shrink the deficit, which currently hovers around 5.5% of GDP, one of the highest in the Eurozone. The proposal quickly ran into stiff opposition. Bayrou lost the confidence vote, was forced to resign, and President Macron appointed Sébastien Lecornu as his replacement. Lecornu now faces the unavailable task of balancing a divided parliament. Some lawmakers are demanding deep spending cuts to restore fiscal credibility, while others insist on protecting households from rising living costs and safeguarding France's extensive welfare commitments. Fitch's downgrade captures the uncertainty around whether Lecornu can bring discipline to the budget process at the moment of fragility. The concerns spelled out by Fitch highlights three core issues. First is the structural nature of France's fiscal deficit. At nearly 6% of GDP, it is far above the US target of 3% and well beyond levels considered sustainable over the medium term. Debt servicing costs are also rising, with the economy now paying significantly more to roll over bonds than it did even a few years ago. Higher interest rates, both globally and within Europe, mean the burden is compounding quickly. Second is the revolving door of political leadership. France is now on its fifth prime minister in under 2 years, and constant reshuffling has hampered the government's ability to plan and execute long-term reforms. Austerity packages are floated, the withdrawn tax reform proposals stall, pension overhauls spark protests. This pattern has undermined confidence not just domestically but among the investors who buy French bonds. Finally, which Fitch stressed the absence of a clear debt stabilization strategy. Without political consensus on how to raise revenue or cut spending, promises of fiscal responsibility risk remaining just that, promises rather than credible commitments. The immediate market consequence of the downgrade is a likely rise in France's borrowing costs. While an A+ rating is still firmly within investment grade, many institutional investors are mandated to limit holdings in countries with weaker ratings. That narrows the investor pool and forces France to pay a premium to attract buyers. Already, the spread between French government bonds and German bonds has begun to widen. Germany, seen as the Eurozone's anchor of financial stability, serves as the benchmark. When France slips, the cost of its borrowing relative to Germans increases. This spread is a critical barometer, and widening gaps not only hurt France's treasury but also send a signal about the perceived riskiness of the Eurozone's second largest economy. There is also a reputational element. A downgrade dents confidence in France's economic governance. Businesses tend to hesitate on new investments in such climates, uncertain whether higher taxes, reduced subsidies, or abrupt policy changes may follow. Consumers too can react by tightening spending if they fear cuts to social benefits or higher living costs tied to austerity. The cumulative effect is that economic growth could slow further, ironically making it even harder for France to improve its debt to GDP ratio. Investors are now asking whether other ratings agencies might follow Fifth's lead if CP Global or Moody's also decide to lower France's credit standing. The effects could multiply. Downgrades increase the risk that the debt is excluded from the more portfolios, and they send a stronger signal of systematic fiscal weakness. Even if France avoids additional cuts in the near term, the downgrade serves as a warning shot that without credible reforms, pressure will continue to mount. For Prime Minister Lecornu, the challenge is immense. He must draft a budget that convinces markets France is serious about fiscal discipline, but he must also avoid triggering the kind of political unrest that repeatedly paralyzed French governments. Energy subsidies are another flashpoint. Rolling them back would help the deficit but raise household costs at the politically sensitive moment. The economy must also contend with the reality the global growth is slowing, which constrains France's ability to grow its way out of trouble. The downgrade has broader Eurozone implications as well. When one of the bloc's largest economies is downgraded, it raises questions about fiscal discipline across the currency union. Investors may start sharing exposures to Italy, Spain, or other members with already fragile finances. Contagion does not necessarily mean a crisis, but higher risk premia across southern Europe could strain the ECB's balancing act. The central bank is already in a difficult position, maintaining relatively high interest rates to guard against inflation while facing signs of economic slowdown. If fiscal instability spreads, the ECB could raise pressure to adjust policy or deploy backstop tools to keep bond markets functioning. What happens next will depend on several moving parts. The upcoming French budget is the most immediate test. If it contains credible measures that show a clear path toward deficit reduction, Fitch's downgrade could remain an isolated event. But if it fails short, further downgrades may follow. Markets will also be watching closely to see how investors respond at upcoming bond auctions, whether spreads over German bonds stabilize or continue to widen, and whether political fractures deepen. Another key question is whether Macron and Lecornu can build the cross-party consensus necessary to pass meaningful reforms. Without it, France risks lurching from the one political crisis to another, all while its debt burden grows heavier. In sum, Fitch's downgrade of France is a warning shot with both immediate and long-term consequences. It signals that one of Europe's core economies is struggling not just with fiscal numbers but with the political and structural weaknesses that underpin them. For markets, it raises borrowing costs and increases volatility. For policymakers, it reduces flexibility, leaving less room to maneuver when the next economic shock arrives. And for Europe as a whole, it highlights how fragile and the balance between fiscal responsibility and political feasibility has become. France may not be one of the brink of crisis, but unless it can stabilize its politics and put forward a credible debt strategy, the downgrade may be the first in a series of blows that reshape how investors view the Eurozone's financial core.